You know, it's funny, whenever you watch, like, a movie about someone getting wealthy, it is always this huge cinematic montage.
Oh, absolutely. It's always an event.
Right, there's a frantic stock trade on a noisy trading floor, or a wild startup idea that suddenly just explodes overnight.
Or somebody walking into a high-stakes casino and just putting their entire life savings on black.
Yes, exactly. It's loud. There are like literal fireworks going off. The whole thing is designed to look like magic, like this dramatic lightning strike of money.
Yeah, we are entirely conditioned by pop culture to expect that. It's presented as this binary switch, like one day you are broke, the next day you are on a yacht.
And it all hinged on one incredibly stressful, high stakes decision.
Right, which is frankly exhausting to even think about.
It really is. But
Yeah,
then you step into the real world and you look at the mechanics of how people actually build lasting financial freedom, and, well, all of those fireworks are completely missing.
completely. True wealth is not about dramatic moments at all.
No, it's not. The actual landscape of wealth building is shockingly, almost aggressively quiet. And that quiet landscape is what we are deep diving into today using this brilliant breakdown from the YouTube channel QuietFi.
It's a great source, really grounded.
It is. Their video is called Five Quiet Habits That Make Real Wealth Almost Inevitable. And honestly, their analysis of these unglamorous behind-the-scenes systems is just a massive relief.
Yeah, it shifts the whole paradigm.
It really does. If you, as a listener, are exhausted by the constant pressure to find, like, the ultimate side hustle or perfectly time a crypto trade, this is for you. The mission today is to extract these five invisible habits that actually work.
Because it's about systems operating relentlessly in the background, establishing financial machinery that doesn't look impressive on, say, a random Tuesday.
Right, nobody's impressed on a Tuesday.
Exactly.
Sure.
But it compounds so powerfully over decades that the results just become mathematically impossible to ignore.
Okay, let's unpack this. Let's look at the first piece of that machinery. Habit one tackles what is probably the single biggest point of failure for human beings, which is relying on how we feel to make long-term decisions.
Oh, relying on willpower is a losing game.
It totally is. I like to think of willpower like a smartphone battery. You wake up on the first of the month, your direct deposit has hit, and that battery is at 100%. You tell yourself, I'm going to save 20% of my paycheck.
But then the month actually happens.
Exactly. Work gets incredibly stressful, decision fatigue sets in, the car starts making a weird noise, and then a friend invites you to a rather expensive dinner.
And you go.
You go, and by the time you actually sit down to manually transfer money into your savings, that willpower battery is flashing red at 1%.
So you justify a break. You promise you'll save double next month.
Yes, which never happens. So how do the quietly wealthy bypass this battery drain?
Well, this is where the QuietFi analysis is so sharp. They point out that wealthy people do not wake up every day and try to summon the discipline to save. They remove human psychology from the equation entirely.
By automating it.
Right. The core philosophy here is that systems beat willpower. The moment income arrives, their system automatically routes specific percentages to savings, investment portfolios, and debt payoff.
Before you can even touch it.
Exactly. The money has to leave the ecosystem before your lifestyle even realizes it was there.
I love that, because if it just sits in your checking account, it triggers that trap, what do they call it? Mental accounting.
Yes, the mental accounting trap. Even if you mentally earmark that money for your future, seeing a high balance makes it feel available.
Oh, the high balance illusion is incredibly dangerous for me. If I log into my banking app and see plenty of padding, my brain immediately starts looking for problems that money can solve.
Right, or it treats the surplus as permission.
Exactly. A $30 takeout order or like a small upgrade to a subscription suddenly feels entirely justified because the container looks full.
And those micro decisions act like a slow leak in the hull of your financial ship.
Uh,
Automation patches the leak by using default bias in your favor.
Make the default the right choice.
Precisely. If your default setting is that the money is sitting in checking, you have to actively fight friction to save it. But if the default is that it's automatically swept into a brokerage account,
You have to fight friction to spend it.
yes, you turn your inherent laziness into a wealth-building asset. The system stays disciplined, so you don't have to.
It's just like the plumbing in a house. You don't think about the pipes, right? They just quietly move the water where it needs to go.
That's a great way to look at it.
But okay, let's say we have this plumbing setup. Capital is flowing beautifully into our investments. What happens when a pipe bursts?
Life's inevitable emergencies.
Yeah. Real life throws a massive crisis at you. A medical emergency, a layoff, a home repair. If every dollar is automatically invested, doesn't the system become kind of fragile?
It does, which is exactly why the second habit is so critical. You need a shock absorber, an uninvested cash buffer.
Okay, I want to push back on this a little bit, though.
Great.
Because conventional financial wisdom right now screams that you should invest every single penny.
True, people hate idle cash.
Right. With inflation constantly eroding purchasing power, holding a large pile of cash in a basic bank account is technically bad math. It suffers from cash drag. So why would a wealth-building system hold on to 6 months of living expenses doing absolutely nothing?
Well, what's fascinating here is how the Quiet Five framework reframes the actual purpose of that cash. The flaw in that conventional thinking is assuming every dollar on your balance sheet has the exact same job description.
Meaning they don't all exist just to earn a high yield.
Exactly. The cash buffer's job is not to generate a return. Its job is to provide calm. It provides a liquidity premium. It acts as a financial firewall, protecting your actual wealth-building assets.
Oh, a firewall. That makes a lot of sense. It prevents a localized crisis from burning down your long-term strategy.
Right. Because without that liquidity, a simple $1,000 car repair isn't just a repair.
It becomes high-interest credit card debt.
Exactly. Or, worse, it forces you to liquidate your investments at the worst possible time.
Oh, like pulling money out of the market when it's down?
Yeah, that introduces a sequence of return risk. Imagine the broader stock market takes a 20% dip, which is totally normal. But that dip happens to coincide with you losing your job.
Ouch.
Right. If you lack a cash buffer, you are forced to sell your depreciated assets just to cover rent and groceries. You permanently lock in those losses.
You are sabotaging your own compounding just because you couldn't afford to wait out the market cycle.
Precisely. The actual cost of a panicked, forced decision is exponentially higher than whatever purchasing power you lose to inflation on a cash balance.
So the idle cash is actually the glue holding everything else together. Having 6 months of liquidity means a job loss doesn't force you to take the first terrible offer out of desperation.
You have the runway to negotiate.
Yeah. A major repair is merely a transaction, not a tragedy.
The cash buffer absorbs the volatility of life, so your investment portfolio can enjoy the uninterrupted time it needs to grow.
Okay, so the cash buffer builds an impenetrable fortress around the money you already have. But here's where it gets really interesting. What happens when new money enters the gates?
Income increases. The danger zone.
Yes. Habit 3. Say your career is advancing, you get a significant promotion, and a major raise hits your account. The source points out that this exact moment of victory is historically where most people accidentally destroy their financial future.
It's the phenomenon of lifestyle creep. The immediate urge to expand your expenses to perfectly match your new income.
It is so insidious because it feels completely justified. The direct deposit hits, the number is larger, and almost instantly, the hedonic treadmill just fires up.
And you start thinking you deserve the upgrades.
Right. I worked incredibly hard for this promotion. I deserve the nicer apartment. I deserve to trade in the old sedan for a luxury SUV. Because the income went up, it doesn't trigger any internal alarms.
You aren't necessarily going into debt, you're just filling the new, larger container.
Exactly. But does this mean we can never enjoy our hard-earned raises? Do we have to live like monks forever?
Not forever, no.
Yeah.
The Quiet Five rule is that you don't have to live like a monk permanently, but you must adopt a stealth wealth approach. You have to strategically freeze your lifestyle for a predetermined period immediately following an income increase.
So you capture the delta.
Exactly. When the raise hits, you keep living in the same apartment, driving the same reliable car. You take the entire difference between your old paycheck and your new one and automatically route it into your financial plumbing.
You turn the raise into assets before your lifestyle has a chance to permanently absorb it into higher fixed costs.
Yes, and the psychological power of this is immense. You are locking in future freedom rather than upgrading your current status symbols.
So from the outside, your life looks absolutely identical to how it looked a year prior.
Right. Coworkers don't see a new car. Neighbors don't see a luxury high-rise. But behind the scenes, your net worth is accelerating at massive speed.
Because your savings rate just doubled. And eventually, once those new assets are compounding, you can selectively increase your lifestyle, but the assets have to come first.
which transitions us seamlessly into habit 4.
Right, how the quietly wealthy view consumer debt. And I love this because the way the source frames debt completely strips away the clinical mathematical language we usually hear.
Yeah, we are traditionally taught to look at debt purely as an equation, interest rates, monthly minimums. But the profound definition offered here is that debt is, and this is a quote, future freedom already promised away.
Future freedom already promised away. Wow. When you internalize that, it completely changes the calculus of financing a lifestyle upgrade.
It really shifts the perspective from leverage to agency. Every single time you sign a contract for a large recurring payment, a $60,000 finance truck, an oversized mortgage.
You are legally binding a portion of your future time and energy.
Exactly. That future labor no longer belongs to you. It belongs to the lending institution. You have pre-sold your future autonomy.
And the entire financial industry is engineered to obscure that reality. They focus you exclusively on the monthly payment. They just ask, what can you have fitted per month?
Because they want to extract your surplus cash flow.
Right. But the quietly wealthy are hyper-vigilant about avoiding those recurring traps. They might easily be able to afford the monthly payment on a luxury vehicle, but they recognize the opportunity cost.
The opportunity cost is staggering. Think about the compounding growth that monthly payment could have generated. By keeping the same reliable car and minimizing obligations, the money that used to go to lenders now buys back your future.
You reclaim your own cash flow. It's the ultimate offensive posture.
It really is.
So let's recap where we are. You've automated the savings to bypass decision fatigue. You've built the cash firewall. You've frozen your lifestyle to capture the delta of your raises. And you've ruthlessly minimized debt.
If you run this playbook, you inevitably generate a massive surplus of capital.
Right. The system is working, but that leaves the final piece of the puzzle, habit 5. Where does the surplus actually go?
And the answer provided by QuietFi is surprisingly and profitably dull.
Extremely dull. The profitable art of being boring.
Yes, it's about ignoring the noise, ignoring the dopamine hits of day trading, and utilizing broad market index funds.
I would argue this is actually the most psychologically difficult component of the entire framework.
Oh, absolutely.
The social pressure to not be boring is immense.
Yeah.
You open any social media platform and someone is showing off 1,000% return on a highly leveraged crypto trade. Your neighbor is bragging about timing a hot tech stock perfectly.
It creates this illusion that everyone is getting rich overnight through complex, exciting maneuvers.
Exactly. Choosing to quietly buy an S&P 500 index fund feels like you are missing out on the party. You feel like a sucker.
But the problem with the party is that flashy, high-conviction investing introduces intense emotion. It requires constant monitoring and almost inevitably results in terrible timing.
Buy high, sell low.
Right. Retail investors historically buy in when an asset is hyped and expensive and panic sell when it corrects. Broad index funds remove the human urge to outsmart the market.
Let's actually unpack why the index fund is so mathematically relentless. It isn't just about diversification, right? An index fund is essentially a ruthless, emotionless, self-cleansing algorithm.
That's a great description.
If an individual company starts failing, its market cap drops, and it automatically becomes a smaller portion of the index. If it goes bankrupt, it falls out entirely.
Meanwhile, the companies that are innovating and growing automatically take up a larger percentage of your portfolio.
You are guaranteeing that you own the aggregate growth of human innovation without having to predict which specific CEO will succeed.
You let the natural upward trajectory of the macroeconomy do the heavy lifting. But, and this is a big but, this mechanism demands extreme patience.
Because the math of compounding is heavily backloaded.
Exactly. The timeline breakdown in the source material is really fascinating, especially regarding the psychological milestones. They highlight the first $10,000 invested as a critical identity shift.
I remember reading that. Getting to that first 10,000 is a grind.
It's a huge grind. It relies entirely on your own labor and your manual savings rate. The market returns on, say, $5,000 are relatively unnoticeable.
Right, a 10% return is just $500. It doesn't change your life.
No, but crossing that $10,000 threshold alters your self-perception. You transition from viewing yourself purely as a consumer struggling to save to viewing yourself as an owner of capital.
You've built the foundation.
Yes. And then you contrast that initial grind with the momentum that kicks in at the next major milestone, which they identify as $100,000 in invested assets.
The math taking the wheel phase.
Exactly. Because once you hit 100 grand, if the market returns its historical average of roughly 10%,
Your portfolio just generated $10,000 in wealth all by itself.
your money begins out-earning your manual effort. The capital's now working a second shift for you.
That is so cool to think about. That $10,000 in compound growth buys more shares, which generate even more growth the following year.
It's the snowball effect, reaching escape velocity. You only get to experience that exponential growth if you refuse to interrupt it.
Right. You cannot abandon the strategy because an influencer made a new options trading strategy sound exciting.
Or liquidate your portfolio to cash, because the geopolitical news cycle sounds terrifying.
Boring, methodical investing, year after decade, quietly separates the individuals who accumulate generational wealth from those who are constantly resetting their progress because they chased the next shiny object.
It completely strips the requirement for luck out of the equation. You weren't hoping for a lottery ticket.
So, what does this all mean? Synthesizing this entire deep dive, we have moved completely away from that cinematic montage of overnight riches we talked about at the beginning.
We really have.
The core takeaway is that true wealth creation is about establishing quiet, unshakable habits, automation to bypass willpower, a cash firewall to absorb life's volatility, the stealth wealth discipline to control spending, zero consumer debt, and patient, boring allocation into broad index funds.
These quiet, boring habits compound over years to create a very loud difference in your life. And the most empowering aspect of this framework is its accessibility.
You don't need a massive Silicon Valley salary to begin.
No, you just need the willingness to construct the architecture.
Yeah.
So here's the challenge for you, the listener, as you look at your own financial landscape. Implement just one piece of this machinery this week.
Just one.
You don't have to overhaul your entire life today. Log into your banking portal and set up one automatic transfer to capture a portion of your next paycheck before you see it.
Or start funding the first layer of that cash firewall.
Or take one extra step to pay down a recurring consumer debt. Put the invisible plumbing in motion.
Build the systems that operate in the background. Which actually brings us back to that initial contrast between the loud illusion of wealth and the quiet reality. The source material makes it clear that true wealth is built silently, keeping the same reliable car, the same house, freezing your lifestyle when you get a raise.
It really is invisible from the outside.
Which really makes you wonder,
Yeah.
if the mechanics of getting wealthy are completely invisible, how many people in your daily life, the coworkers you sit next to or the neighbors down the street, are secretly wealthy right now?
While the ones flashing the expensive upgrades are just trapped paying off the illusion.
Exactly. How many of those flashy folks are just exhausted, desperately trying to finance the illusion of success? It completely changes the lens on how you view wealth around you.
It forces you to completely reevaluate what success actually looks like.
It absolutely does. Keep building those quiet systems, protect your future freedom, and we will catch you on the next deep dive.